All right, let's just jump right in. The market right now, it's all over the place. I mean, you've got these high-flying momentum stocks just getting absolutely crushed. But then, right in the middle of it all, it's earnings season. So you're seeing these huge winners and, well, some spectacular losers. The big question is, what is really going on under the hood? We're going to break it all down, the data, what the analysts are thinking, and which stocks are really telling the story.
And yeah, that's the billion-dollar question, isn't it? One minute you feel like we're about to blast off to new highs. The next, it feels like the floor is about to give out. So is this just the market taking a breather, a healthy pause, or is something bigger at play here? We're going to dig into the numbers and see what the pros are saying to try and make sense of it all.
So here's where we start. The big picture is that the market is basically going nowhere, just treading water. But if you look just beneath the surface, there's a huge shift going on. Investors are clearly getting nervous. You can see the money moving into those safer, defensive stocks. Think consumer staples, healthcare, while the exciting, high-growth stuff is getting left behind. That's a classic risk-off signal.
And this week's scorecard just paints the picture perfectly. I mean, look at this. The S&P 500 barely budged. But the transports, which are a great barometer for the economy, they were up pretty nicely. But then you look at the other side. Small caps, which had been on a tear, got absolutely walloped, down almost 3%. This is not a market where everything is moving together. It's a market that's getting very, very picky.
So how do you make sense of all this sideways chop we're in? Well, one analyst, Tom Bowley, has a theory. He thinks we might be in what technical traders call an ABC corrective pattern. It's actually pretty simple. You get that first big drop. That's your A wave. Then you get a little recovery rally, but it's weak. It doesn't make a new high. That's the B wave. And if the theory holds, what comes next? You guessed it, the C wave, which is the next potential leg down.
And this theory actually gives us a concrete number to watch. The target for this potential C wave could be around 64.19 on the S&P 500. Now that's not just a number pulled out of thin air. It lines up perfectly with a really key technical level, the 20-week moving average. A pullback to that level would be pretty normal in a healthy bull market, but believe me, in the short term, it would definitely sting.
Of course, all this technical stuff isn't happening in a vacuum. We are right in the thick of earnings season. And when you have giants like Netflix and Tesla reporting, their numbers can either pour fuel on a bearish fire or completely turn the ship around. How they react is a huge piece of this puzzle.
So first up, Netflix. They reported they missed, and the market's reaction was brutal. And I don't mean it just drifted lower. The stock gapped down hard, opening way below where it closed the day before. That's the kind of move that screams big institutions are heading for the exits.
And analyst Tom Bowley doesn't mince words about it. He points out that this sell-off happened on the heaviest trading volume Netflix has seen in a year, and it shattered a key support level on the chart. He's pretty convinced the pain isn't over and that the stock is probably headed even lower.
And then you've got Tesla. Right after the bell, they reported their numbers and boom, the stock immediately dropped 3.5% in after-hours trading. Now, a move like that in a company as massive as Tesla, well, it has consequences. It's the kind of thing that can easily weigh on the entire market's futures and set a negative tone for the next day, which really adds some fuel to that bearish C-wave theory.
But hey, it's not all bad news. While some of the big tech names are sputtering, the same analyst is pointing out that money is rotating somewhere else. So let's flip the script and look at 4 companies in those more value-focused sectors that just crushed their earnings and look like they're ready to break out.
Let's start with Delta Airlines. They beat on both revenue and earnings, which is great. But what's really exciting here is the trifecta. You've got a classic bullish cup and handle pattern forming on the chart, and it's happening right as the stock is heading into its strongest month of the year. I mean, a 9.5% average return in November over the last 13 years, that's a serious tailwind.
Okay, next up, let's talk about the railroad giant CSX, another one that beat on earnings. But check this out from a technical perspective. This stock has basically been going sideways for 4 years. 4! And it looks like it's right on the verge of a massive breakout. But the stat that really made me do a double take is this. CSX has gone up in November in 11 of the last 12 years. I mean, wow, talk about consistency.
Then we've got American Express, another strong beat on both the top and bottom line. And with these guys, the breakout isn't just a possibility, it's happening right now. The stock is already pushing into new all-time highs, and that move is backed up by solid numbers and, you guessed it, a great seasonal trend, with November typically delivering a nearly 7% gain.
And last but not least, General Motors.
And they didn't just beat earnings, they smashed them. It was a huge beat. That surprise sparked a monster technical breakout on some of the heaviest volume of the year, sending the stock into blue sky territory. And just like the others, this is all happening just as the stock enters its strongest seasonal period of the year.
So we've seen the weakness in big tech and the strength in value, but there's another, much uglier side to the story. We have to talk about what's been happening to some of the market's hottest, most popular momentum stocks. And this is a serious cautionary tale.
Let's start with iron. After an incredible run that had everyone talking, the stock just fell off a cliff. It lost a third of its value. And this wasn't a slow bleed over months. This happened in just 6 days.
And it wasn't a one-off. Look at Bloom Energy, another darling of the market, flying high. It also cratered, dropping 30% from its peak in that exact same 6-day stretch. The speed of these collapses is just stunning.
But maybe the most shocking example is OKLO. This stock hit a high of nearly $200 a share. And then, in 1 week, it plunged 41%. All the gains that took months to build just evaporated in days.
And, the analyst who pointed this out really nailed it. Chasing these red-hot stocks, look, it can be an amazing ride on the way up, but you have to know the risks. Because, as he says, when they pull back, they tend to pull back really hard. It's that old saying, right? The stairs up, the elevator down. And that elevator is moving at lightning speed right now.
So all of this brings us back to the big picture. You've got shaky tech giants, strong value stocks breaking out, and momentum names imploding. It is a very messy, very confusing market. And to top it all off, we are standing at a huge seasonal crossroads.
And this really lays out the whole tug-of-war perfectly. So for the bears, the argument is simple. We are literally in the middle of what is, historically, the single worst week of the year for stocks. Not great. But for the bulls, the cavalry might be just around the corner. Because starting next week, we enter the most bullish period of the entire year, a run that usually lasts right through the holidays. So you've got these two massive opposing seasonal forces clashing right here, right now.
So that's our final question. We're at this critical inflection point. Defensive stocks are leading, tech is faltering, and we're in the middle of this epic seasonal showdown. Something has to give. Is that bearish short-term trend going to win, and are we going to see that C wave down? Or does that powerful year-end seasonality kick in and send the market flying higher? The next few weeks are going to be absolutely fascinating to watch.